You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. It is a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the CBOE over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit ORATS.com or email Matt Amberson at matt@orats.com. And now, it's time to learn how to implement options in your practice. It's time for the Advisor's Option.
All right, everybody. That music means it is that time of month, listeners. Yes, it is time once again for the Advisor's Option, the program here on the old Options Insider Radio Network. For you, the busy financial advisor and asset manager out there. We get it. You're busy dealing with your clients probably a lot these days, given what we're seeing in the markets right now. You don't have time to keep up with the latest developments in the world of options. We know from talking to a lot of you that you all want a little bit more options education. So we're here to help you with that and a whole bunch more. My name is Mark Longo from the aforementioned network, as well as, of course, from the ever compelling theoptionsinsider.com, the place to go to get a lot of Matt's and his team's latest earnings news, earnings move results, earnings season, earnings trades, a whole bunch of great reports, and a whole bunch more. Because you like you folks, it's all there for free. Theoptionsinsider.com is the place to go. And let's see who's joining me on the old program today. I just mentioned his reports, so you know I'm joined once again by my compatriot in all things Advisor's Option Crime, the founder and principal over there at ORATS, a.k.a. Options Research and Technology of Services. Easy for me to say, a.k.a. the Oracle of New Hampshire himself, Mr. Matt Amberson. Matt, welcome back to the Advisor's Options, sir. I'm sorry we had such a quiet and boring month with nothing to talk about for you, sir.
Yeah, and, I was on vacation and listening to the Option Insider on the beach. And your voice sounds so much slower right now. I listen to it at 2x.
You do like 3x,
I have to get
right?
used to this.
Probably sound like a chipmunk to you. I find our content is very conducive to a little bit of a day on the beach. It's nice stuff to keep you engaged while the sand and the waves are washing over you. And also joining us today here on the old Advisors Option Program, a newcomer to the Advisors Option Program, Mr. Rick Rosenthal, the Director of Business Development over there at the CBOE. Rick, welcome to the Advisors Option Program.
Thank you very much, Mark. It's a pleasure to be here, even though in Chicago it is not warm. It is sunny, and it's just a delightful experience to be on your program.
Well, you have been on TWIFO one or two times in the past talking about all things Russell 2000. Like I mentioned, this is your first appearance on the Advisors Option. A little bit of a different audience for this program. So let's start there, Rick. Why don't you give our Advisors Options audience a little bit of an overview of what your background is in the derivative space, as well as what it is you do day to day over there at the CBOE.
Sure. I've been in the industry for about 40 years. For those who have seen the movie Trading Places, I was on the floor at the Merck, the Board of Trade, CBOE, in the heyday, 80s and 90s, when the markets were robust. We had a vibrant floor. My role was an institutional broker. I was running a desk for Cargill and then Dean Witter. And our clients were primarily hedge funds, pensions, endowments, foundations, mutual fund managers, et cetera. So I had the privilege of working with some of the biggest and most experienced managers in the world, trading on behalf of as an agent, on behalf of the clients, futures, options, ETFs, et cetera. I joined CBOE in 2015 with the responsibility of focusing on business development within the FTSE Russell product line, and have since transformed into business development within the investment advisory space. So I'm very happy to be on your program today and talking about how options can be used to manage risk and generate income.
And really quick, Rick, you mentioned you kind of focus on the advisory space in addition to, of course, our old friends over there and FTSE Russell Land. Some people may be wondering, why CBOE on an advisor show? What is CBOE bringing to the table for the advisor audience? I know you guys have a few products, a few indices that may intrigue them. Give us a quick rundown at the top of the show here, Rick.
Sure. So the investment advisor space is interesting because there's over 300,000 investment advisor representatives, reps, and the vast majority do not use options, let's say 30% or less. And the reason for that is primarily the lack of education. And so CBOE has a mandate to try to get advisors to become more comfortable, more aware of the benefits of using options-based strategies. So our role here is to provide that education. I'm not selling any product. I'm not selling anything. But what I want to do is help advisors get comfortable with the subject matter, understand, even though these are considered derivatives, and what comes with derivatives, leverage and risk, using well-designed options-based strategies are very effective in managing risk and generating income and enhancing the risk-adjusted returns on a portfolio. So CBOE has created a number of indexes measuring the hypothetical performance of various strategies. We've got tools. So let's go.
All right, let's go indeed. Right on into the P&L statement.
Earnings announcements can move markets, but what is the options market telling us about upcoming earnings events? Let's find out with the Earnings Volatility Report.
All right, everybody, welcome to the P&L statement. The statement that was born during the height of the pandemic, because we kept coming back to this show every month, and we found ourselves spending so much time breaking down what the heck just happened. What did we just see? What unprecedented things unfolded in the world of options or volatility since our last show? It got so frequent that we decided we had to make a segment out of it. And it's a good thing we did, because this month would certainly qualify in a lot of respects. Matt, let's start with you here, sir. I was obviously joking at the top of the show. We have seen yet again, January once again coming roaring in like a lion, seeing things not quite unprecedented this January, but certainly things we have not seen in quite some time. So walk us through. I know a lot of our listeners are excited. They want to hear what you had to say, Matt, especially last week. Coming into last Monday, you fire up your screens, you turn on your machines, you see we're down 4+. I think it was 4.25% at one point in the NASDAQ, over 1,000 points in the Dow. And then we see this epic mother of all reversals. Of course, vol spikes to about 38 and change in the VIX before coming off. We see a similar thing play out the next day, not quite as extreme, 2+%, but then reversing all of that. Later in the week, we see a strong rally that gets reversed as well. It's just a week of epic comebacks, epic reversals. Matt, walk us through what's been lighting up your tape since the last time we chatted, sir.
Yeah, so thanks, Mark. It's been quite a month, and at the beginning of the last month, we had just started to see, I watched these indicators, implied volatilities, but then forward volatilities, and what we started to see was those relationships break down. So one of the things I like to look at is, a forward volatility relationship. So that's something where you might look at a 30-day implied volatility, constant maturity that people like to talk about, and then a 90-day. And then let's say right now we are getting right about flat. Our contango is about 0. So, it might be a 30 and a 30. And of course, in between the 30 and the 90-day is 30. Usually we're backwardation, contango, and that means the 90-day might be higher than the 30-day. So you might have the 30-day being 25 and the long dated being 30. And so between that 30-day and 90-day, it has to be the implied forward rate has to be higher than 25, even higher than 30. So to drag in order for that 90-day to be valid at 30. So you might have a 32 or 33 or 34 forward volatility. Now, that's somewhat exciting, but then what we do is we compare that calculation of the formulaic forward volatility to a time spread calculation. And it's a little bit too technical. I'll skip over it, but that relationship is usually pretty stable. But when the market gets in duress, when the market starts moving around a lot, that relationship gets out of whack, and we can start to see that. And that's one of the canaries in the coal mine that we use. And I know it sounds pretty vague, but that and contango a lot of people use to see what's that something's coming up, something's happening in the market. So we're lucky as option research people that we could see when things are happening. And we started to see that last month when we were on the show. And then I was on volatility views and kind of said it's getting to concerned level. And then after that, it really got concerning. I think we said spicy since the spicy meatball was on. So it did get very spicy after that. So what we're seeing now is those indicators that indicate duress are turning and going the other way, including the put call slope, which we'll talk about a little bit too. So the forward volatility relationships are starting to get more stable. The contango is starting to, the backwardation has come out of it. So it's about flat now. So what we want to see if we're bullish the market, we want to see contango in there. So over 0. And then we want to see implied volatility start to fall. When you see those things, that means the market usually is calming down, and usually it's a bullish sign. Slope can be tricky. That has a lot to do with supply and demand, but often when you get to a low, you'll get the puts implied versus the call implieds. The puts usually are trading a lot higher than the calls, especially in the ETFs. And then what will happen is when you reach a market bottom, then the calls will start to get bid up. And that's what we're seeing a little bit. So all those things, Mark, we had the duress, we saw the early signs last month, and now it seems to be calming down. So everyone can take a big sigh of relief, and because the ORATS numbers are looking a little bit better, Mark.
So in your own verbiage, sir, market's a little bit less spicy these days than the last time you were with us, Matt.
Yeah, that was fun with the meatball, calling for extra spice on the way. Yeah, so it's like making an order, at your Diablo pasta, and the spice is coming. But now we're done with the spicy pasta, Mark. We're going on to dessert right now.
Yeah, no more, maybe not ghost pepper wings anymore. Maybe more like your standard buffalo now for a little while. We shall see. We shall see if the spice starts making its way back into the markets, listeners. Rick, let's go out to you. Same question for you, but I have an addendum for you as well, since this is your first time joining us here in this mad, insane new year that is already off to a wild start in 2022. I want to start with you. Looking back a little bit, obviously 2021 was an insane year in a number of different categories. What stands out to you as some interesting highlights or lowlights from the options or volatility or indeed the advisor space as it pertains to this audience? And then afterwards, of course, we can get into your thoughts on what we're seeing out there right now in the market this month.
Sure, thank you. So VIX, this index CBOE calculates, is looking at the expected 30-day volatility. And this is also known as the fear gauge. What we're seeing most recently is VIX has been climbing and reached a 52-week high on the 24th of January, peaking at 38.94. And if you want to compare that to the average of 19.54, it's indicating that there's plenty of fear in the market. You can see an inverse relationship between VIX and the S&P 500. So what you see is the bearish sentiment has maybe reached a peak near term, but it is certainly there. Not only in the S&P 500, we calculate a similar volatility index on the Russell 2000. That peaked in December. It's currently around 45. Well, it made a high of 45, and that averages about 27. Coincidentally, on the 24th, we saw a single daily record volume of over 63 million options contracts traded throughout the 16 exchanges, and that compares to an average daily volume of 45. So if you want to look at a theme, we're seeing a lot more options trading activity. In 2021, it was up considerably, and we're seeing that continued in 2022. And I think you can tie the two, volatility and the opportunity to manage risk and trade volatility seems to be attracting a lot of attention these days.
That it is, as we keep on rolling. It's part of that season, listeners. It's that time of year where we're seeing a lot of names pop off that are contributing to this wild volatility environment. So let's break it down, a little bit of the old earnings volatility reports.
Earnings announcements can move markets, but what is the options market telling us about upcoming earnings events? Let's find out with the Earnings Volatility Report.
All right, everybody, welcome to the Earnings Volatility Report. You guys love Matt's data so much. Made a whole segment about it. Again, you guys can check out these reports for yourselves. Hot off the presses as of this morning over there. TheOptionsInsider.com is the place to go to learn more. Big names popping off this week. Big names like Alphabet, EA. Just seeing some more news. Looks like in the gaming sector coming off right now. All these Microsoft kicking off a buying spree with their deal of Activision. Sony's racing to buy other names. So hot news popping off this week as well. Qualcomm, Spotify, and the company formerly known as Facebook, now Meta, which I can't stand that name. On Wednesday, Thursday, we have Eli Lilly, Merck, Amazon, Ford lighting up the tape just about every day these days. Got a lot of meme stock characteristics to it, lighting it up this week on Thursday. Snap, Activision, Blizzard. Friday, a name you may be familiar with, called the CBOE, popping off before the bell there as well. Matt, it's been a wild start to the season. Week 1, blowing the doors off, 107%. Week 2, I think, to put it charitably, pumping the brakes a little bit. We're seeing twice as many companies report and roughly half of the amount of vol we saw in week 1. So catch us up. What have you been seeing out there? What's lighting up your tape in the world of earnings volatility right now, sir?
Well, this is similar to last season, where we had a very busy and a lot of volatility in the first week. And then generally what we see is the first week isn't that busy. And then the second week gets a little bit better for option holders. Third week is even better. And the fourth week is usually the best for option holders. The last two earnings season, the first week has been the best for earning straddle holders. I think what happened too is we got all that volatility in coming into the market, and that really blew up a lot of the earnings moves that were implied. So it was a higher bar that these companies had to get over, and they weren't getting over it. So we saw that that was kind of the talk of COVID. Volatility was high, and the earnings weren't as important. Like last week, there were so many macro things going on that the individual name earnings weren't really popping off, as you say. So what I'm seeing is that I think that we'll get a little bit of a spillover effect this week because there's quite a few macro things going, but I think it's going to start again where the earnings matter, where people are starting to look at more of the fundamentals of individual companies rather than kind of the overall macro events in the economy and affecting the market. And we'll start to see some of these names pop off a little bit more, meaning the actual moves will be up to and maybe equaling and going over what's implied in the market. So that's what we've seen so far. And as you say, this is a huge, like our earnings report is pages long this week, and so many companies, it's even hard to look through them. Of course, we can sort through them and look. We put out these earnings trade reports that are fun to see because only a few companies really meet those criteria. And as we talked about before, we're looking at focusing mostly on these time spreads. They've worked the best in our back testing. And so we could go down from hundreds of stocks just to 4 or 5 that we can kind of isolate in our earnings season report. And Mark, I don't know if I've even talked to you about this. Maybe briefly, we now are putting our stock scanner out there for alpha users. And one of the scans is the upcoming earnings this week. And then you could look at over or undervalued straddles and a bunch of other bits of information. So a lot going on at ORATS around earnings. And this earnings season is interesting, and I think about to become more interesting, Mark.
Yeah, you're right. Speaking of interesting, you guys are just going crazy on the data front over there, Matt. You have so many different offerings now. You're right. I'm looking at the earnings trades report as we speak. Everyone's been waiting with bated breath for some new earnings trades to come out. We got some listeners here looking at some long calendars in Robinhood. A lot of you have been asking about Robinhood lately, listeners. Matt and his team looking at some long calendars there, Juniper Networks, as well as a few others. You got some interesting trade ideas. Looks like some long calendars, some long straddles, and a couple of short straddles as well, Matt. So you're kicking off the earnings trade season with a sampler of almost everything.
Yeah, and it's just based purely on the numbers, what worked in the past to indicate larger moves. Obviously, it's very difficult to be long these straddles, so we just pick the cream of the crop. And gives people something to look at for educational purposes only, I should say, Mark.
Very educational indeed. You guys can check out those reports for yourselves, of course, theoptioninsider.com. If you want to check out everything Matt was just talking about, including that cool stock scanner. I know a lot of the people in our live chat are the ideal alpha and beta testers of that kind of stuff. Check it out over there at ORATS, ORATS.com. is the place to go. Meanwhile, it's time for us to go on into our next segment. It is time for Options 101.
It's time to learn how to manage risk and generate additional income for your clients. It's time for Options 101.
All right, everybody, welcome to Options 101, where we delve into an options strategy or trading technique or tip and explain how you can utilize it in your clients' portfolios. And today's Options 101, we went back to revisit the collar on our last show, given your feedback and everything that's going on and talking to Rick here ahead of the show, it seems like it's a worthwhile time to revisit that revisitation once again, because there's a lot of talk, a lot of questions, a lot of comments. A lot of people have collars on the brain right now. Remember, so if you want a deep dive into all things collars, go check out the archives of this program. We did a deep dive on it back on August. We kind of just went back into it again last episode as well, talked about some of our favorite or perhaps least favorite structures right now. These things get kind of dicey in the environments we were kind of hanging out in recently, not so much right now, where the put skew is starting to get very, very big out there. In fact, we have a question of the week about that right now. You guys can play along, give us your feedback right now. At Options is the place to go over there on Twitter, asking you effectively, what are your favorite strategies for these types of high skew environments? Gave you a variety of choices: long puts or put spreads or collars, short puts or put spreads, or bullish risk reversals, which is, of course, selling the put and buying the call, put butterflies or ratios, and then the infamous other. And right now, this just went live before showtime. Right now, 80% of you are looking to the dark side, saying you're selling puts or put spreads or bullish risk reversals, which is kind of what I expected, even though it looks like put butterflies and ratios are making a bit of a comeback. This just went live. You have the rest of the week to play along. So if you're listening after the fact, head on over to @Options and make your voice heard. But Rick, I said we just talked about collars, but this is a topic we talk about frequently here on the show. In fact, I've called it in the past the holy grail options position for financial advisors, because so many of them are coming to this show managing long equity accounts on behalf of their clients. They're looking to get some sort of protection, but they don't want to pay an arm and a leg for it. And that's kind of where the collar comes in. I know you've been looking at a lot of different data, a lot of different research over there, Rick, when it comes to zero cost collars. So why don't you break it down a little bit for us? What are your thoughts on collars, maybe their suitability to this environment right now, and the old zero cost collar, sir?
Sure, thank you. So I think a lot of advisors are looking at, how do I protect my client's portfolio in a cost-effective manner? And one of the concerns is the cost. It's expensive. Insurance is expensive, especially if you're buying insurance for downside price protection and volatility is screaming. So there's a number of collars, and one of the collars that we're going to highlight today is the zero cost put spread collar. Now, CBOE calculates a variety of strategy benchmark indexes based on various underlying indexes. We have one on the S&P 500, the Russell 2000, MSCI, et cetera. So what I wanted to point out is each one of these strategy benchmark indexes has a ticker associated with it. So if you're interested, you can go to CBOE's website. You can type in CBOE.com/CLLZ, and that will take you to the web page that will give you a description on the CBOE S&P 500 zero cost put spread collar. We have something similar for the Russell, CLLR, so same concept. So what is the CLLZ? The CLLZ is designed to hedge against downward price movements on the S&P 500. You're buying a put spread, 2.5% out of the money. You're buying a 2.5% out of the money put. You're selling a 5% out of the money put, and then you're selling a call to finance that put spread. So if you look at today, the S&P 500, roughly 44.83. The 2.5% put would be buying a 43.70 strike, selling the 42.60 strike, and then cursory look, this would be probably selling a 46.25 call. And of course, the term is defined by the advisor. How long do you want that protection to be in place? And in this case, I was just looking at the Feb 18, which is the standard AM settled option, the third Friday of February. The benchmark indexes are calculated using the third Friday expiration, and it's updated every month, looking at where the 2.5% and the 5% of the money put is at the end of the expiration for each month. So I wanted to highlight how can this be used? And the case that I think is most interesting is when Mark Cuban decided to sell his company, Broadcast.com, to Yahoo. And this goes back to 1998. His company, Broadcast.com, was sold for $5.7 billion. And in return, Mark Cuban received 14.6 million shares of Yahoo, which at the time was trading at $95 a share. So his concentrated position had a market value of about $1.4 billion. In order to protect the value of his holdings, what he decided to do was put on a zero-cost put spread collar, which allowed him to hold his position, locking in his share value during this lockup period. So in this case, what he did, he bought an 85 strike put. He sold a 205 strike call. And he did this for zero. In fact, I misspoke. It was a put spread. He just bought the put, sold the call, out of the money call, and he was able to do this for zero cost. Now, during this time period, the price of Yahoo did go up, and it went up above 200, but he held on to the collar position, and it's possible to do that without being assigned. If you do this with flex options, you can do a flex option European style, so it will not be called away or signed. And I presume that's what he did in this case. Subsequently, Yahoo stock price did go down way below the $95, and he was able to protect his holdings and not have his position called away or have to sell any part of it. So this is a very effective strategy for managing risk of a concentrated stock position, as well as if you want to do this on a portfolio or using an ETF. Strategy applies across the board.
I'm glad you brought that up, Rick, because we talked about collars many times here on the show, but somehow we've never talked about what is probably the most infamous example of a collar out there. I heard it many times back when I was on the floor of the CBOE. Oh, did you hear that this Mark Cuban guy used a collar? And then, of course, we all know what happened to the high flyers of the dot-com bubble, listeners, your Yahoos and your AOLs and everything else. All went straight down not too long after. And so having that put certainly saved Mark Cuban's bacon. That deal, all that Yahoo stock would have been worth a lot less if he hadn't done that. So that's always been one of the more infamous examples that's bandied about. That allowed him to do all the other crazy things he's done since then, buy the Mavericks, do his Shark Tank. He wouldn't have had much money to put to work in Shark Tank if he hadn't gone along and done that, college. Let's start there, Mr. Matt. I'm curious. You've been around the CBOE back in the day as well. I'm sure you've heard this story many times. What are your thoughts on the infamous Mark Cuban collar?
There was also a Microsoft collar that went up big. I had guys, I backed guys in the CBOE back then and traded. And, what would happen is they'd start putting it on and you'd have the position and then they'd move the price and move the price and move the price. So you had to hold on for a long time, and it got pretty painful. Let's just put it that way. And yeah, my comment on collars is the way that I like to look at it is, I like to look at the calls separately from the puts. Now I know some people it's a little bit more difficult to explain, but there are different. When we're doing back testing, there are different days to expiration. And different prices that tend to work better for different stocks and different types of stocks. So a lot of our back testing, we've done some huge 3 million back tests on a group of stocks, for example, that's up on our blog.orats.com. And we show like some of the rules that have worked well, like avoiding earnings, like try to get a high spread yield, like 30 days is usually good. And then on the converse, when we're buying puts, those are there are times and back tests that we like to look at. Often a very long term one might be good, or again doing a time spread if you're allowed to, or a put spread collar, like was mentioned. So, the way I like to look at it is just, if you can, and you have a slightly more sophisticated user of it, is to try to separate those and backtest, optimize, take a look at those and go over the payoff pictures and et cetera with the individuals, and then go from there, Mark. So that's how I like to do it.
And normally I like to save the listener questions till the end, but I'm going to cheat because we have so many that are just immediately relevant to this segment here. Let's go to this one first from Tom S. He says, hello, Mark and crew. Big fan of the advisor's option. Not sure why others haven't jumped into the world of advisors and options, as it is an underserved market. Shh, don't tell anybody, Tom. This is only for us here to play in the advisors and options waters here. He goes on to write, so glad to hear your episodes last month and in August about collars. I've been experimenting with SPY protective puts in some client accounts, and so far the results have not been encouraging. Oh, I'm sorry to hear that, because I've heard your admonitions about spending outrageous amounts of premium on your out-of-the-money put hedge, and that seems to be the case. My question is, why do these puts remain so expensive if they are so difficult to make pay off? Who keeps bidding these things up? And what do you recommend for sources of protection right now? He puts in parentheses, obviously he's a listener. He says, outside of Matt's dubious cheap puts, that's a little too advanced for me right now. Yeah, we talked about that on the most recent episode as well, listeners. Check out that if you want a little bit more detail. And we have a related question. He mentions August. Let me just bring this one up. We talked about on August episode as well. This one came in from MTL35. He says, I very much enjoy your advisor's option program. I listened to the entire archive now, and it has improved my client approach to derivatives tremendously. Thank you for your assistance. It is invaluable. Well, you're welcome there. He goes on to say, I also have a question, if you have the time, on your program. Where do we currently stand on the collar strategy? I agree with the host that collars can be the, quote, holy grail for financial advisors. However, the current, and he puts it in caps, extreme bid to the out-of-the-money index puts makes executing such a strategy difficult to prohibitive in the current market environment. You're stuck getting not much protection or giving up too much upside to make the two legs offset each other. Am I missing something? Is there a better way to approach collars in these high valuation markets? And if that's not enough, we have one here from Neats with a Z, says, is it even really viable to do index collars anymore, or are the call premiums versus puts so skewed that it is practically impossible to get realistic price levels? So 3 questions here, Rick. Let's start with you on the efficacy of collars right now, because as they point out, not so much this second, but we have seen in recent weeks and months, the levels of put volatility in particular get extremely expensive, and that, as we know, can be prohibitive to doing collars. So, Rick, we're getting a lot of questions about the efficacy of collars in those high type of skew environments. What would you say here for our listeners, Tom S., MTL35, and Neats, sir?
Right. So, like any other insurance product, the best time to buy insurance is when volatility is low. Looking at a hedge when VIX is at, above its average, 19.54, it's close to 40. Obviously, the put skew is going to be pumped up, and the cost for protection is also going to be increased. So, looking at various ways to put on a hedge, buying a put is going to be prohibitive. Premiums are too high. Putting on a zero cost put spread collar makes a lot of sense. Question is, for what time period? And so I think this is where it becomes as much of an art as it is a science, looking at the right strikes to optimize the hedge and the cost. Perhaps this is where ORATS comes into play. In case of CBOE strategy benchmark index, it's fairly formulaic. You buy the 2.5%, you put, you sell the 5%, and then you're selling an out of the money call, collecting the premium from the call to offset the cost, the debit of the put spread. So using that concept, it can be applied to equities, and it's a matter of going through the machinations and finding out the right strikes to meet the cost and the amount of protection you're looking for over whatever time period. And I'd like to point out that this concept has been used for the buffer protect indexes, And you can see the popularity in these indexes because of the ETFs that have flourished using CBOE'S buffer protect approach, similar to zero cost. They're using the premium collected on the call to finance the buffer protection on the downside. So again, this can be applied to equities, ETFs, or indexes.
Mr. Matt, same question for you here. What do you have to say for Tom S, MTL35, and NEETS? I do like Tom S. You can tell he's a listener because he also mentioned that your dubious puts idea was a little bit too advanced for him, sir. But what do you have to say here for the rest of the folks, sir?
Yeah, I mean, I agree that you want to be buying these when the vol is low, but there's still things to do when the volatility gets higher. So, a couple of things that I do personally. Now, if you're allowed to sell and you're allowed to do some type of a put spread, for example, I still like the longer term way out of the money puts, and you could then find some way out of the money, slightly maybe farther out of the money that you could sell against it. So what you're doing then is you're selling an option and buying another one, and then if you have a scanner like we have, we could find the ones that we think have a relative value that look good. And so there's a lot of things that you have to do, get a little bit more creative, but you could definitely still get some protection out there. That's the important thing. If you're looking for protection and the volatility is high, you got to get a little bit more creative, because you're right. You can get thumped pretty good if the volatility comes in. Another way to do it is if you look at the payoff picture of a calendar and a way out of the money calendar. So the calendars make money when you go towards that calendar strike. So I'm looking at a scan in our option scanner. The stock's SPY's about 450, and you're looking at about 430, 420, something like that. As the stock goes down to those prices, that's when the calendars are worth the most. So you can buy a calendar, which you could buy a May and sell a Feb or something along those lines, where you have a few months in between there. And as the stock drifts down, that's a good strategy for that type of a move. Now, if the market's screaming and it goes through your price, you're not going to get the protection. But if you have enough of these put calendars, though, they can pay off, and you just have to be kind of ready to take them off as the stock goes down and approaches your strikes. So those are a couple of things. Another thing, as I'm owning these puts and the volatility went way up, I found a couple that were expensive and sold some of those. So let's say if I hold 10, I maybe sold 2 or 3 and get a ton of premium. And, as the market kind of rallies back up, those things get destroyed, and my way out of the money puts still kind of hold their value, even though the Vega's coming in a bit. It's going to go down a little bit, but not as bad as those. So you have to get a little bit more creative, Mark, when the volatility is high. There's no way to get around it, I don't think. And but you can do some calendars, you can do some verticals, and you can do some. I guess what the last thing I mentioned was a diagonal, with a bit of a ratio. But it's a little bit more complicated. But try to figure out some other strategies that you might want to do when the volatility is higher than normal, Mark.
All right, well said, sir. Our second tilt at the collar windmill, and as many months, given your feedback and your questions, I have a feeling it's not going to be the last time we're going to talk about collars. It'll probably be popping up on our radar again soon, though. Meanwhile, it's time for us to keep on rolling. It is time to get the buzz.
Busy financial advisors don't have time to follow the latest developments from the options market, so we do it for you. It's time to get the buzz.
All right, everybody, welcome to The Buzz, where we break down some of the big stories in the world of options and derivatives that you may have missed since our last episode. And we do finally have the official numbers for the mad, insane year that was 2021. Remember on our last episode, listeners, we were speculating. We thought we knew about a ballpark of where we were going to go out for the year. But, the question we had on our lips to start the year last year, and a lot of people were asking us throughout the year, was, can this insane, explosive options volume party, can this thing continue? Obviously, we kicked off the year hot and heavy with the meme stock explosion. Vol was racing towards the 40 handle last January. Sounds kind of reminiscent of this January as well when you think about it. But then, of course, the question remained, could we keep seeing these records? And the answer, usually month after month, was yes. Most months we came across was the most active, whatever it was, February, March, April in the history of the options business. And oftentimes they were also the most active month ever in the history of the options business. So if you look at the top 5 months options history, most of them, if not all of them, were last year, listeners. So in a crazy year, now we finally have the official numbers from our friends over there at OCC. And yes, we did blow the doors off. We were threatening 10 billion to go out the year, listeners, which, of course, we were already talking about 2020 being an insane year. That was 7.52 billion contracts on the tape, listeners, at the end of 2020. And a lot of people didn't think we'd hit that level anytime soon, given what we're seeing in the market. But we blew the doors off in 2020. And 2021, like I said, just even more aggressive. You knew how crazy of a year it was, listeners, when we surpassed that 7.5 billion level by mid-October. We had already beaten that by mid-October. The rest of the year was just gravy. And so closing in on 10 billion, 9.93 billion options contracts changing hands. Well, I should say derivatives contracts. OCC also clears some futures and a few other things. If you want to get pure options, it is 9.87 billion contracts. That's billion with a B, listeners. A 32% increase over the previous year. I'll just give you some numbers really quickly. Then I'll go around the horn and get everyone's thoughts on the mad, insane year that was 2021. Like I mentioned, overall volume, 9.87 billion options contracts. We drill down a little bit further. Equity options, 9.36 billion. It's up 33.7%. That includes ETF options. If you pull those out, that was about 2.7 billion. It's up about 5.1%. So ETF options have been one of the few laggards out there. Total index volume was 503 million contracts. That's up 8.8% compared to 2020. So again, insane. We're talking also getting to the point where we're almost hitting about 1 billion contracts a month. So if we stay on that pace, and again, we don't know the numbers for January yet. They'll be coming out tomorrow. I'll have a nice re-release from our friends over there at OCC in our hot little hands. But if we're staying on that roughly close to 1 billion contracts a month pace, then we expect 2022 to be even more tumultuous from an options volume perspective. Rick, we'll start with you. When you're not talking to me on a show like this, you spend your days over there at the exchange, so you're knee deep in what's going on from a volume perspective. First off, let me get your overall thoughts on just, were you in the camp that thought we could beat 2020 last year, or were you like me? I'll admit it. I was pretty skeptical coming into last year. I did not think we could eclipse that 7.5 billion level, just seeing everything that it took from a global macroeconomic perspective to hit that number in 2020. I didn't think it was possible. I was proven wrong. I'm curious, were you skeptical like I was at the beginning of the year? And what were your thoughts as we not just beat it, but dramatically surpassed it towards the end of the year, Rick?
I said at the top of this podcast, I'm old school. I mean, I was on the trading floor when you had open outcry. What's changed in the marketplace is just amazing to me. You've got the democratization of the market. You've got individuals who are following social media messages in Reddit and other locations and getting trading ideas. And you have the ability to trade on your cell phone. You've got the Robinhoods of the world that make it real easy for individuals to come up with an idea and trade on it. When you see the increase in volume of 32% year over year, the majority of that is in the individual names, the single names, focusing on some of the meme stocks, AMC, GameStop, et cetera. I'm kind of surprised on one hand that the increase is as dramatic as it was. but I'm not surprised that it was increased, period. Options have really been adopted by the masses as a way to express a view in the market. It's a very cost-effective way to express a long or short view, and it's also a wonderful way to manage risk. So I think this creates kind of a platform for much further growth down the road, and so I'm encouraged by it. Another interesting thing I'd like to point out is that the volume is not simply coming from Generation X. I've got a friend who has a big following in his commentary, and he's telling me that a lot of his followers are 55 to 70-year-olds who have time on their hands and want to, trade options. So, Mark, this is a new era.
That it is, yes. Many new players joining the world of options, many new listeners listening to shows on the network. So it has been fun to see just the overall growth in all things options over the past couple of years. Matt, I've been chatting with you just about every month out here over the course of the past year. So I know you weren't perhaps quite as skeptical as I was kicking off the year about the volume numbers, but I don't know if any of us had a nearly 10 billion handle to round out the year. So what were your thoughts on these I think the technical term is insane numbers that we're seeing in the world of options? And corollary to that, do you think we could rival that again next year?
So my thesis is that track the Fed, and the more money that they have sloshing around, the more it finally gets into options. And so, I think this year, if the Fed does close the spigot a little bit, I think we're not going to have near the record. So I'm going to go on a record saying that we're not going to get the record this next year, which is a tough position to defend. I was reading an article that the public has discovered puts, and it appears that these retail investors and the ones that are trading small lots like 10 or less spent a record amount of money establishing new bearish positions. As you know, Mark, I like to look at the 5 delta implied volatility versus the 75 delta and look at the component weighted. So what we do is we average all the components of the underlying ETFs. And that held for a very long time. So that ratio got above 1, which is quite incredible. Meaning the 5 delta implied volatility was above the 75 delta. Those 75 delta calls. So those are actually 25 delta puts. So that's pretty incredible. It has since come down. And I think, as this article that I was looking at has noted, that the small lots people, they're getting tired of buying the dip and they're buying puts now. So, what we've seen is, as I agree, there has been an incredible small lot participation in this, in options. And, we're seeing it now go from the calls to now they're bringing down the skew to recognizable levels, Mark.
BTFD fatigue finally hitting the market out there. Is it possible? I don't know. We were joking about it on our last episode, back on Monday, last Monday's episode, where we said, hey, what happened to the BTFD crowd? And no sooner did we say that than every major index completely reversed and wiped out all their losses for the day. So they were obviously listening to the show last Monday and they dove in pretty hard. But interesting to what you're saying about the skew there, Matt. That's certainly one to watch. I, of course, was on record being very cynical last year. I was happy to be proven wrong out there, of course, the options volume. So I don't know, maybe I've had some of the cynic beaten out of me now, because it does seem like this new audience that has come is here to stay for a while, and they are putting up some numbers out there. It's not like the usual flash in the pan crowd we've seen. They've been around for a while now, and they're still remaining pretty active. I'm with you that the Fed has been the rising tide that lifted all boats out there for a while, and of course, a nice bull market is usually nice to options traders. They like that kind of thing. It'll be interesting to see how they fare with a little bit more choppy, more turbulent market. But still, I'm not quite prepared to say that we can't hit those levels again. I guess we'll know for sure once January will be a bit of the bellwether for us. We'll know for sure when those numbers come out tomorrow from OCC how we're trending for the year. Speaking of numbers, Rick, I know when you're not talking with me here on a show like this, you guys over there at CBOE and your research team putting out a lot of research that will interest particularly a lot of the audience for this program, the advisors and asset managers out there who are looking for interesting new ways to perhaps enhance yield or generate premiums or returns or protection for their clients. Give us a quick rundown of some of the more interesting stuff you guys are working on out there, Rick.
Thank you. So CBOE does commission white papers. We commissioned a white paper from Wilshire Associates. They looked at the performance of selected option writing strategies used to reduce risk and enhance income. These are based on the S&P 530 Delta Buy Right, Put Right, the Russell 2000 Put Right, MSCI Put Right, MSCI Emerging Put Right, etc. So that was last year, and we also commissioned a paper from EQD focusing on case studies, how options on the mini Russell 2000 can be used to generate income and manage downside risk. Both papers are available. If you want to come directly to me, feel free, Rosenthal at CBOE.com, or you can go to CBOE's website and go under education. In addition to that, we have a series of webinars. They're available at no cost. Just simply have to register. There's one coming up tomorrow, 10 a.m. Eastern Time, Option Fundamentals, the Greeks with Shelley Natenberg. And then on the 9th at 12 Eastern, 22 option strategies in 2022 with Sean Howell from E-Trade and Tim Withers from Withers Analytical Consulting. So we're very interested in supporting and providing education, research, and we have a variety of tools on our website, which can be used for trade optimization, calculations, etc. So I encourage you to just go to CBOE.com, navigate a little bit, and if you have any further questions, please feel free to reach out to me.
All right, everybody. That music means an hour flies by when we're talking advisors and options. But before we go, Mr. Matt, we're just talking about all the fun, interesting tools you have over there in the land of ORATS, including this cool new scanning tool. I want to check that out myself. If our audience over there wants to check it out for themselves, where should they go? What should they do, Mr. Matt?
Yeah, Mark, we should get together and get some alpha testers from the Option Insider.
I think we got some willing participants here, sir.
Yeah, it's been great. So, yeah, a lot of what I want to tie in to ORATS is more of the information where we could screen down stocks and get, a lot of our users, especially the advisors, are looking for certain types of stocks, high PE, low PE, and having strategies based on those. So we've made the stock scanner where you can literally use hundreds, we could make up ratios. So it's an infinite number of fundamental implied volatility, historical volatility, earnings-related information, dividends-related information, forecasts, and then narrow down, this huge list of, now we have over 5,500 symbols that trade options, and then send them over to the option scanner. And the option scanner has hundreds of different strategies that you could apply, and then look at, we have, payoff pictures, we have, you could filter down on all the Greeks. You can filter on open interest. Just a ton of things. So you could get really down to the strategy that you're looking for using these scanners, and it's really nice to streamline. People have said we're saving them a lot of time now. So we've got that, and then on the horizon here, over the next month, we're going to have a whole fundamentals page, so you'll be able to find out all the information, historical earnings information, historical implied volatility, et cetera. So it's a plethora of things coming, Mark, and so we're excited to be here. Email me at matt@orats if you want to alpha test, or just go to ORATS.com and get yourself a reduced fee trial and get in and start checking the stuff out.
Check it out. ORATS.com, ORATS.com is the place to go. Give them a follow on the old Twitters as well, at Option Rats, one of the more memorable handles out. He's always tweeting out something interesting about a particular back test or analysis or something you probably didn't consider about the world of options. Of course, you can always check out all those reports we talked about at the top of the show. Earnings move results, earnings season, and now the newly minted earnings trades reports over there at the optionsinsider.com. And of course, you know to go to check out the latest from our friends over there, the OIC. Optionseducation.org is the place to go to kick the tires and light the fires. Check out their advisors section over there as well. A lot of great data and research that you can utilize and arm yourself with when you sit down with your clients, want to explain maybe why they should consider implementing options in their portfolios. A lot of great data for you over there. Optionseducation.org is the place to go. We have to go on out of here, but of course, we'll be back again tomorrow. All of you out there in the secret club will get to join us for our next Pro Q&A session. Should be a good one. Jim Carson joining us from Kai Volatility Advisors. I have a feeling a lot of you have questions about volatility. Well, we'll be answering those tomorrow. Of course, back again on Wednesday, Education Wednesday, Options Bootcamp, Options Playbook Radio. You don't need me to tell you about those shows burning up the charts these days. Of course, back on Thursday, This Week in Futures Options with our friends over there at CME and FTSE Russell, as well as the Option Block, your bi-weekly dose of all things active options trading out there. Friday volatility views, and of course, for you Secret Club folks, we have Options Oddities. Then back again next week and all the way through to next month. Wait a whole nother month, but we'll get there, listeners. Trust me. And the next episode of the Advisor's Option. We'll see you then.
Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the CBOE over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit ORATS.com or email Matt Amberson at matt@orats.com. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.